Dear students, welcome to my channel, Dr. V.R. Pudili, Professor of Management and Economics. I am doing a series of videos on capital structure theories. In this video, I am dealing with Modigliani and Miller theory of capital structure or hypothesis on capital structure. Capital structure theories, Modigliani-Miller theory or hypothesis on capital structure. There is a viewpoint that strongly supports the close relationship between leverage and value of a firm. In other words, it supports that there existed an optimal capital structure. The optimum capital structure may be defined as the capital structure or combination of debt and equity that leads to the maximum value of the firm. There is an equally strong body of opinion which believes that financing mix or the combination of debt and equity has no impact on the shareholders' wealth, and the decision on financial structure is irrelevant. In other words, there is nothing such as optimum capital structure. These views are reflected in capital structure theories. Important capital structure theories include one, net income theory or net income approach. 2. Net operating income theory or net operating income approach. 3. Modigliani and Miller theory or approach. 4. Traditional theory or traditional approach. Modigliani-Miller theory of capital structure or hypothesis on capital structure. The Modigliani-Miller hypothesis relating to the relationship between the capital structure, cost of capital, and valuation of the firm is similar to the NOI approach. The significance of their hypothesis is that it provides behavioral justification for constant overall cost of capital and for constant total value of the firm. The basic proposition of the approach is that given the assumptions, the total value of a firm must be constant irrespective of the degree of leverage. Similarly, the cost of capital as well as the market price of shares must be the same regardless of the financing mix. The operational justification for the hypothesis is the arbitrage process. Arbitrage refers to entering simultaneously into two transactions which exactly balance or completely offset each other. The approach illustrates the arbitrage process with reference to valuation in terms of two firms which are exactly similar in all respects except leverage, so that one of them has debt in its capital structure while the other does not. According to Modigliani and Miller, such homogeneous forms are perfect substitutes. The total value of the homogeneous forms, which differ only in respect of leverage, cannot be different because of the operation of arbitrage. The investors of the firm whose value is higher will sell their shares and instead buy the shares of the firm whose value is lower. The behavior of the investors will have the effect of 1. Increasing the share prices or value of the firm whose shares are being purchased, and 2. Lowering the share prices or value of the firm whose shares are being sold. This will continue till the market prices of the two identical firms become identical. Thus, the arbitrage drives the total value of two homogeneous firms in all respects except the debt equity ratio together. In this slide, I had given graphical presentation of Modigliani-Miller hypothesis on capital structure. In this graph, I had taken degree of leverage on x-axis and value of the firm and overall cost of capital on y-axis. In the above graph, we can observe that value of the firm and overall cost of capital are independent of degree of leverage, and value of the firm curve and overall cost of capital curve are parallel to x-axis. Assumptions of hypothesis on capital structure. 1. Perfect capital markets implying 1. Securities are infinitely divisible. 2. Investors are free to buy or sell securities. 3. Investors can borrow without restrictions on the same terms and conditions as firms can. 4. There are no transaction costs. 5. Information is perfect. That is, each investor has the same information which is readily available to him without cost. And 6. Investors are rational and behave accordingly. 2. Business risk is equal among all firms within similar operating environment. And 3. The dividend payout ratio is 100%. Dear students, in this video, I had dealt with Modigliani and Miller theory or hypothesis on capital structure. Thank you.